Hey everybody, Signet here with the Bullish Bears. Today we're going to do an introduction to futures. So there's not going to be any strategies in this. We're not going to go through, any complex or special order types. We're just going to kind of give a background on futures and, put a little bit of thought behind why we watch futures on an intraday basis, even if we don't plan on trading futures. Right? If you trade in the marketplace on a day-to-day or an intraday basis, keeping track of futures is really, really important. And we're going to kind of walk through some of this and just kind of get past the language barrier when it comes to futures. And let's just jump right on into it. So, the topics that we're going to cover. Futures contracts. We're going to talk about the oversight of the futures market, enforcement of the futures market. We're going to talk about the characteristics and the categories. Contracts, legal agreement, right? This is an agreement between a buyer and a seller. Something is being contracted. Once you enter into a trade, you are obligated, right? It's not a lot of different between futures contracts and options contracts when it comes to the responsibility and the legal fact that you are signing an agreement, right? If you are buying futures contracts, then you're legally obligated. If you're selling futures contracts, then you're legally obligated. And think about this for a moment. When we think about futures, a lot of times we think of the S&P 500, but futures products kind of revolve around so many different things, right? There's commodities, there's monetary commodities, there's agricultural commodities. Um, think about it: lean hog, coffee, wheat, corn market, soy. If you're selling a contract in the futures market on corn, imagine having to actually produce that corn, right? It's a funny thing to think about, but there is a legal agreement and you are obligated. Derivatives contract. Something, as I was saying, something is being traded. That could be metals, minerals, financial instruments, energy, agricultural commodities, foreign currency. Think about it, the peso or the lire, right? So enforcement and oversight. We don't have PDT when it comes to trading on the futures, and that's because there's a different oversight and regulation enforcement, right? And so they're different than stocks and options. Futures oversight and regulation, futures contracts differ vastly from stocks and options in terms of the regulatory bodies, right? We got the Commodity and Futures Trading Commission and the NFA, the National Futures Association. Futures contracts are regulated by a completely different body than stocks and options, and that's a good thing for us, right? Uh, there's been a lot of research and a lot of testing that's been done, and this PDT rule is a burden on the community, and yet due to antiquated uh, I don't have a word for it, due to the power structure at the top of the food chain, the the idea of changing something, any kind of change, is a struggle, right? And if you think about government and regulation and red tape and how long it takes to kind of quote turn the ship around, uh, it's a pretty solid fact at this point that PDT is a burden, but there is value in the concept of the PDT, and so since that value still resides there, there's no real hurry or uh, excitement in changing that. But with futures, we don't have to worry about PDT. It's a different regulatory body. So the characteristics: no pattern day trade rules, massive leverage, overnight and extended trading sessions, highly leveraged with minimal costs. So think about this for a minute. So when I first got into options, I had a small account and I wanted to be able to use the little bit of money that I was trading with to leverage or make more money than I could make just from trading stocks. And the reason I focused on options is because if I wanted to trade a share of a stock that was $5, then each share that I was going to buy or sell was going to cost me $5, right? But if I did that in options, the options contract would let me uh, manage 100 shares, and I could do it for a lot less money. All right, so that gave me leverage and allowed me to use my small account to control large share sizes and make money, right? And so it's the same thing when it comes to futures products. You're going to take control of futures contracts with a very small amount of money. And this leverage allows you to take control of a very, very scary large amount of something, right? The overnight and extended trading sessions. This is so cool. When I worked a day job, I had to try to kind of fit trading into my daily thing, but I was already committed to being at work and doing a job that I had been hired by my company to do, not to be trading, right? With futures, not only can you get into the futures market with not too much money, but you can also trade it after hours. So you can trade it on Sunday nights, or you can get up in the morning and get your trading done before going to work, right? And that is that is a freedom that you don't get from shares and from options contracts. So there's a lot of bonuses or a lot of pluses in trading futures. The categories are a little unusual. Most people really don't think of all the different things that futures allows them to trade, but they really open the door to trading everything: oil, bonds, the indexes, gold, silver, right? Here are the categories of the futures contracts: metals, interest rates. Does that surprise you? Energy, FX currency, equity indexes, agricultural products. You can trade so many different things. Trading futures, hedging, reducing the risk of an existing position. For an example, like most products you trade are probably tied in some way to the S&P 500. If your account is heavily positive delta, or if the beta weight is too significant in one direction, you can hedge against that. Uh, you can hedge against a negative market by hedging with an E-mini S&P 500 futures contract. This offers you an opportunity to offset that portfolio risk. So if you are new to hedging, or even just new to the idea of protecting your portfolio, think about it like this. If you've got a lot of trades on and they're all to the short side, you want to protect yourself in case the market explodes to the upside, right? That's hedging. And so kind of a scenario would be if I have 5 trades that are all uh, bearish positions, and I want to protect myself against an uh, an explosive move to the upside, then I could trade an S&P 500 futures contract that would make me money as the market goes up, right? And that way, as my positions are losing money, my bearish positions are losing money because the market is going up, I would be making that money back in my futures contract. This would give me the opportunity to not close my bearish positions, because it could just be a short-term pop to the upside before continuing on lower. I wouldn't want to abandon my positions, right? So this would give you an opportunity to leave those positions in place and make money during this short-term reversal so that your portfolio remains balanced and not showing that negative impact, right? Hedging. But you can also use them for speculation. You can intend to profit directly from outright purchase and or sell of futures contracts. Think about that. If you believe the price of coffee can appreciate in the coming days or weeks or years, you could go out and buy coffee, right? You could buy coffee contracts. Think about where coffee is grown, and then imagine what would happen to those crops if some natural storm event happened and wiped out those crops. What's going to happen to the price of coffee, right? And you can speculate on that. You can go out and buy coffee futures, anticipating that price would rise due to the supply and demand, right? So a lot of different ways. Why bother with futures? Futures impact the market. They impact order flow. Even if you have no intention of ever trading futures, you still, as a trader, absolutely want to know what's going on in the futures market. Futures move the marketplace. The S&P 500 futures drive order flow in the marketplace. You want to watch futures when trading anything intraday, because trading, it is order flow. Often stocks move up and down intraday because of the movement in the S&P 500 futures market. For an example, Microsoft can move the futures, but the futures can move Microsoft. For an example, if the NASDAQ falls, the tech stocks in the NASDAQ fall, right? So the NASDAQ futures can impact tech stocks, and one single massive tech stock can impact NASDAQ futures. So yes, both sides can be affected. And one thing that you got to keep an eye on intraday as a trader is recognizing how much monetary value is in each futures contract, and recognizing that when you see a 5-point move in a futures market, how much money was just moved. That's speculation. That's forward looking and anticipating somebody put some big money on the line, right? You want to recognize that and use it in your intraday trading. Even if you never intend to ever trade futures, just recognizing the value and the monetary impact. So learning futures, it's not difficult. It really isn't. It's just a language thing. The language used in trading changes as we swap through different products, right? When maybe when you started out, you were looking at shares of stocks, and then from that you went to options contracts. Now we're into futures contracts. You got margin, you've got portfolio margin, day trade margin, overnight margin, contract margin. You got a leverage product. What does that mean, right? What's leveraged products? Options contracts are leveraged. Futures contracts are leveraged. When you use contracts, each $1 move in the market can make massive money because of leverage. And each $1 move in the market, that's a point. So in pairs trading, perhaps that would be called pips, right? But in futures markets, that's a point. A $1 move, that's a point. That's going to be important later on. We measure leverage with ticks. Ticks vary with different products. So most people begin with a single product like the S&P 500. But we got examples, right? Oil futures slash CL. Up or down $1, the contract makes or loses $1,000. Right? It's freaky. S&P 500 futures slash ES. A $1 move up or down, and the contract makes or loses $50. So you might see the market, the S&P 500, move $1, but those contracts made or lost $50. Not all contracts are created equal either. Leverage and futures contracts, they differ, right? Just like I was talking about with oil, $1 move will make or lose 1,000, and yet with the S&P 500, a $1 move will make or lose 50, right? So they're different. When looking at futures, you really need to know how to value each one of those contracts. And it seems a little overwhelming at first, right? There's so many different products out there. But unlike trading shares or equity products, chasing after ETFs, trading a bunch of options, in futures, a lot of people, a lot of retail traders, they really trade one or two products. So you don't need to go out and learn all the different tick values and tick sizes for every single product out there. If you never intend to trade corn, then you never need to worry about the tick size in corn. All right. So don't let this become some vast weighted thing just sitting on your shoulder like you got all this stuff to learn. You can just pick one product and become a master at that thing. Futures language. We got notional value, ticks and tick size, and tick values and margin and points and handles, and it just starts to really pile up at first, right? But it's not a scary language, and it's not a foreign language, right? It's just what I call that bank speak. It's geek speak. Don't run away screaming when the insider language is used to discuss or describe trades and futures. Always remember that your broker will be friendly and helpful. Call them with your questions. You're the client. They will not treat you like an idiot. They will not laugh at you. They will not talk down to you. They will help you. It is good to learn these names and terms. It's a great idea to become familiar with them as you grow into your trading career. You do not need this language to be productive or profitable, but you do need to understand contract value in the futures market you want to trade. You need to understand your risk and all the aspects of margin, but you don't need to use all the fancy language. Tick examples. On the left, we've got the market. And from left to right, as we read, we've got market, symbol, tick size, tick value. So working down the list here for a moment. Oil, CL, 1 penny tick size. Each penny is a $10 move. Yeah, that's pretty scary. The S&P, ES, tick size is 25 cents. Every 25 cents is worth $12.50. NASDAQ, 25 cents. Each 25-cent move in the NASDAQ is $5. Bonds are a little bit different. That uses fractional dissemination. Yeah, that all of the market used to use fractal dissemination, but now you will still find a few products, but bonds are definitely the one that I watch most often and that gets my attention. So notice that these different markets have different tick values. One that may stand out is the oil, right? Because there are 100 pennies in a dollar, and a 1 point move in oil. Remember, a point is $1. A 1 point move in oil is a $1,000 move in the contract. So for every dollar that oil goes up or down, that contract makes or loses $1,000. Another one that stands out may be the bonds. Bonds use fractal dissemination, and there is a 32 tick in bonds. Right? So each point, remember points, is 32 times $31.25. That equals $1,000. So just like in oil, for each point that the bonds move, that's $1,000 up, $1,000 down. Right? But what you see there with that uh, odd look for the tick size, you notice that oil, the S&P, the NASDAQ, each tick size was in pennies, and this in bonds is in fractions of a dollar, right? So you would see bonds go from slash /01 to slash /02, 3, 4, right, all the way up to 32. It's uh, it's different. It just takes a little getting used to. Contracts. With contracts, you've got to know your tick size. You've got to know your trading hours, because all these futures products, they don't all open and close at the same time, right? They have different um, open times, closing times. Corn is a great example of this. Corn opens with the regular market, and yet it closes 2 hours early. Right? And if you didn't know that and you were still in a corn position sometime after lunch, next thing you know, your broker closes you out for the day because it's settlement time and the rest of the market's still just doing its thing. You need to know the overnight margin on these products, because all the different futures products, they all have different margins. So regardless of what futures contract you intend to trade, it is really, really critical to familiarize yourself with the variables that go with it. You need to know the expiration of the contract, and you don't need to learn all of them, right? If you don't intend to trade anything other than the S&P 500, then you don't have to go out and learn all the other settlements, right? You just worry about learning the trading hours and the margin and the expiration of the S&P 500. It doesn't have to be a massive task. Notional value. You might have heard me say this a few times already. It's the real value of the contract. What's it really worth? It, it's the total asset value at spot price. So, spot price. The notional value tells us what the futures contract is really worth. The way you solve for notional value, in order to calculate that, uh, you must first understand what each tick of the contract is worth. So for an example, say the S&P 500 E-mini contract trades in 25 ticks. Each 25-cent tick increment is worth $12.50, right? We covered that just a few minutes ago. The notional value math in the S&P 500 E-mini would be something like, we take the minimum tick size, 25 cents. We know its worth, which is $12.50. Since there are 4 ticks in a dollar, right? 25 cents. There's 4 25 cents in a dollar. So we know that a 1-point move in the S&P 500 is 4 ticks. Each tick is worth $12.50. That's $50, profit or loss. But what we need at this point is its spot price. Well, if the S&P is currently trading for around 2250, then we multiply the current S&P 2250 by the 50, which was our 1-point move. So 2250 times 50, it's $112,500. Yeah, we'll do a couple examples of that, though, right? Don't think that you have to just stop and scribble it all down. You can take some screenshots as we go through this and just kind of absorb where it is that we're going with this, right? So we're adding it up. We calculate the notional value of a NASDAQ futures contract. So we got the NASDAQ, the NQ. Each tick is 25 cents. There's 4 ticks in a $1 move, and each tick is worth $5. So a point, 4 ticks is a point. A point is $20. If NASDAQ's spot price is 7430, then we would take 7430 times 1 point, $20. That means each contract is $148,600. That's the notional value. NASDAQ futures notional value, like we just did, 7430 times 20 is $148,600. Does that scare you? Because it should. right? It really should. It should make you stop and feel the weight of the decision to trade futures products. But even if you have no intention of ever trading a futures product, stop for a moment and understand why we would watch these products on an intraday basis. That is a lot of money. So we can do the same thing again, right? Like I said, we're going to have quite a few examples here to kind of burn this into your thinking. The ES tick value is 25 cents, which means in a $1 point, there would be 4 ticks. Each point, each $1 move is worth $50. If the spot price of the ES is 28.78, then we would take 28.78 times 50. It's $143,900, right? It's almost $144,000 per contract in a 1-point move. Hopefully, you have begun to understand why we watch the futures products intraday. The weight of the S&P futures market drives order flow, and the sheer value of money that is moving through the market makes the futures a beast that must be respected and understood. If you intend to trade these leveraged products, have a solid understanding of what you are trading and what is actually being done. If you trade a contract worth $143,900, you need to respect it. You need to fear it. An unspoken understanding. The S&P 500 is the most important product in the marketplace. Even if you never trade futures, you still need to understand this important fact. You need to know when the S&P 500 futures market is open and know when it closes. This is really, really important. Futures trading hours. The contracts traded various times depending on the contract you select. It's imperative to understand not all futures contracts have the same trading hours. Just like in the other examples that we've talked about, it is important to know your product. You have to know when it closes. So let's talk about the S&P 500 for just a moment. I really don't want to geek out on you, but this is where we're going to start to we're going to get serious. Really, it's time to put the gloves on. All right. The S&P is the father of the entire marketplace, and in fact, VIX is calculated based on S&P index options. The CBOE Volatility Index, right? The VIX, it's a measure of the stock market's expectation of volatility, which is implied by the S&P 500 index options. It's calculated and published by the Chicago Board Options Exchange, the CBOE. So what does this mean? It means the volatility, or the VIX, is nothing more than a mathematical calculation of overall market expectation. Remember that. The expectation of the market. Volatility is movement. When looking at volatility on a chart, volatility is a measure of how far something is expected to move, and it's put into a percent. That's it. Volatility is just another name for movement. How far do we think this stock is going to go? Today's VIX index is based on the S&P 500 index, the global proxy for the US marketplace. And the VIX index estimates expected volatility directly from the weighted prices of SPX puts and calls, covering a wide range of strike prices. The value of this SPX option portfolio is what the world recognizes as the VIX index. Right? The world recognizes this, and it's all based on the S&P indexes. Right? And we can trade the S&P futures. Even if you don't trade the futures, recognize how much power and how much pressure comes from the S&P. Right? This is where we're going to just get all geeked with it. Volatility measures the frequency and magnitude of price movements up and down that a financial instrument experiences over a certain period of time. The more dramatic the price swings, the higher the level of volatility. Volatility can be measured using actual historical price changes, right? And that's what we call historic volatility, realized volatility, or it can be a measure of expected future volatility, and that is implied volatility. The VIX index is a measure of expected future volatility, right? It's what we call implied vol. It's important to understand that the volatility we look at in the market, it's just a fancy word for expected move in price. That's it. When whenever you think volatility, hear that definition in your mind. Expected move in price. What's the volatility in SPY today? What's the expected move in price today? It is a forward-looking indicator, and it gives you a measurement of anticipated price action. The VIX index is an up-to-the-minute market estimate of expected volatility, and it's calculated by using the midpoint of real-time S&P 500 index options bid-ask quotes. More specifically, the VIX index is intended to provide an instantaneous measure of how much the market thinks that the S&P index will fluctuate in the next 30 days following every single tick of the VIX index. I know, but look, you can go back and rewind and watch this again and let it sink in. You don't have to absorb it all at once. No one person or committee determines the level of the VIX index. Instead, the VIX index reflects an equilibrium price for risk as reflected in the price of the SPX options, which rise and fall based on the flow of orders from traders around the world. That's a lot, right? Remember also that we can trade futures on volatility. The tick size is a nickel, 5 cents. The tick value is $50. So a 1 point move in the VIX is $1,000. Remember, 1 point is a dollar. There's 20 nickels in a dollar, right? So we would take 20 times 50, that's $1,000. The S&P 500 differs from the Dow Jones Industrial Average and the NASDAQ composite because of its diverse constituency and weighted methodology. When the SPX moves, you need to pay attention to it. It doesn't matter what you're trading in the marketplace. You want to keep your eye on what's going on in the S&P 500. The other thing that is critical in watching the market is bonds. That's /ZB. Bonds. There's more money in bonds than in the S&P. But in the S&P, it's one of the most commonly followed equity indexes, and many consider it one of the best representations of the entire U.S. market. There's over $9.9 trillion indexed or benchmarked to this index, to the S&P 500. And yet, bonds, there's more money in bonds, right? But there's more people watching the S&P. So now we're going to get into margin. Margin is one of those things that changes depending on what it is that you're talking about, right? That used to frustrate me constantly. That margin, when you would be talking about one thing, means something completely different if you're talking about something else. It's like the word dude. All right, so when it comes to trading futures products, they all have a different margin. That margin is calculated by a system. It's the span system, right? Span margining. And what it's doing is it's calculating what if scenarios, right? Like, what if the market crashes? What if the market explodes? What if the market just ranges sideways? Span evaluates overall portfolio risk by calculating the worst possible loss that a derivative and a physical instrument might reasonably incur over a specified time period. Usually that's one trading day. So this is done by computing the gains and losses the portfolio would incur through these different market conditions. Intraday and overnight margin requirements are different. Margin on futures can differ from intraday to overnight. Intraday margins are typically more they're more lenient, right? They don't require as much. So less capital is held. Overnight margin requirements hold more capital. Recall, margin on futures can change in real time depending upon volatility. Each brokerage firm assesses the internal margin limitations based on an exchange's minimum margin requirements. Futures and exchanges reserve Firms and exchanges reserve the right to change margins at any time, but they typically just follow whatever the whatever is required. Another thing to talk about, expiration. So futures contracts do expire, but they don't decay like options contracts do, right? There's no decay there. Futures contracts expire and are either cash settled or physically settled. Yeah, we're going to get to that one in a minute. So each futures market has different expiration cycle, and the contract is a binding agreement to take possession of a product or to give someone else a product, or it turns into a cash settlement, right? There's things that we can't actually produce, right? Like say we're trading VIX. Well, I can't go out and grow VIX. I can't shovel it out of the ground, right? I can't give it to somebody, so it's not a product. That would have a cash settlement. But imagine we were trading coffee and you sold somebody a futures coffee contract and it expires. So cash settlements. Contract is settled in dollars and cents. You don't want to hold futures contracts until settlement, right? This is a very, very risky, it's a high risk thing that leaves traders exposed to really harsh risks. Cash settlement turns a contract into cash, win or lose. But physical settlement requires the holder to either produce the commodity or to take delivery from the exchange. How would you like a truckload of coffee showing up? Don't panic. The coffee truck is not going to show up at your door. Most brokers do not allow for physical settlement, and they will close your position and not allow that physical settlement. All right. So depending on the broker you have, and most brokers are going to do this, they will liquidate your position before it expires. So they will make sure that you don't end up with a truck coming to your house. All right. Futures expirations. You can take the cash, you could roll the contract, or you could close the contract. Right? You have choices when you're approaching expiration, and you can do something about your position. So rolling. When I was first beginning to teach options, we had to deal with rolling, and a lot of people think of rolling their position when it's a losing position that they think can turn around and become a winning position if they just have more time. But rolling a position shouldn't just be something that you think about doing if you're losing. Suppose you're in a good trade, suppose you're in a good position and you want to continue to hold that position, but your contracts are going to expire. You could roll that position forward in time and keep it, right? So rolling futures is a process of closing an expiration contract with limited time remaining and opening a new contract in a longer dated future. For an example, if you bought to open an NQ futures contract for the June expiration, suppose in early June you decide to keep the trade. You would sell to close your June NASDAQ contract, and you would buy to open, suppose, like a November NQ contract. one thing that we do need to talk about is the lock limit. So there's a trading halt that is applied to the marketplace. And you might have seen this a lot in penny stocks or intraday trades in small markets, or I mean, even in big markets. Um, it just explodes in one direction or another, and it triggers a trading halt, and the market just pauses. Well, that can happen with futures too. So these circuit breakers will shut down trading. You can buy, but you can't sell. If you want to read more about that, you can look up the New York Stock Exchange Rule 80B trading halt. Lock limits, it is infrequently used terminology in today's market. I really don't hear people talk about lock limits very often, but it is essential to discuss lock limits when we talk about futures contracts. Futures can and do have the capacity of going lock limit. Lock limits vary on each unique product, although the following example, which I'll go through here in a moment, is designed to both introduce the idea to you and then scare you into understanding and recognizing futures markets going into lock limit. So price limits in the S&P 500 are set by the CME group. The U.S. equity index price limits and corresponding CME and CBOT rules are designed to coordinate with circuit breakers as applied by the New York Stock Exchange Rule 80B. So 7%, 13%, and 20% price limits are applied to the futures fixing price, and those are effective from market open, Sunday through Friday. And let's see, so 7, 13, and 20% price limits are applied from market open till market close. That's 8:30 to 3 Central Time, right? 9:30 to 4 market time. And that's Monday through Friday. 5% up and down limits are effective. They're put into place between 5 p.m. and 8:30 a.m. Central Time, Sunday through Friday. All right, so at 4 o'clock p.m. market time until 7:30 a.m. market time, so overnight hours, Sunday through Friday, there's a 5% up and down limit. And then between 3 p.m. and 4 p.m. Central Time, Monday through Friday, there's an up or down trigger limit of 5%. It's just important that we just catch that real quick, and we want to talk about that for a moment, right? This does happen, and it's happened more frequently. In the last few years, there was a number of these that happened. I believe Brexit caused a trigger that shut down the marketplace, and so those examples, you can go back and read more about it. It does happen, so you just want to be aware of that. All right, so we're going to come over now to the broker and take a little bit of time just to maybe point out a few things that might help you when you are interested in becoming more familiar with futures markets. So in the upper left portion, you can see where you would normally add some ticker symbol. If you click into that, this is what you would normally see, right? You get the drop down, it's on all, and it's showing you everything. We could just type in whatever it is that we want, and that would be how we would jump between different markets, right? So there's SPY, right? Maybe we go back up and we go look at Microsoft, or I don't know, Facebook. It doesn't really matter, but you get the idea. That's normally where we would go and change the chart, right? But Thinkorswim offers a lot more than that in this little drop down. You notice all these boxes here. What you can do is you can flip over to futures, and what you get at that point is tick size and tick value with initial margin. So this is really cool. If you're interested in trading, for an example, the S&P 500 E-mini contracts, just type in ES, click on the box. We see the tick size, the tick value, just like that. So you don't have to write it down, get a bunch of notes or anything like that. You can just flip right over there and look and see what the tick size is and the tick value is on whatever product it is that you want to trade. We talked about fractions when looking at bonds. And so you can see if we go in here and we look at bonds, the tick size is a fraction, just like I had discussed. So there's 32 fractions in a point. Each tick is $31.25. All right, so bonds are a little different. You can see how it's using fractions over here on the right. So instead of seeing monetary value there, right, if we was to go to something like, oh, I don't know, right, back to SPY, this is normally where we see the value of what it is that we're looking at. There's SPY, and it's broken out into dollars, but I believe if we zoom in enough, it'll start breaking it down into nickels and dimes, and then finally it breaks it into pennies. If we just keep zooming in, there you go. So there's penny increments in SPY, but it's a dollar size, right? That's what we see over here. But with bonds, and there's other products too that use fractions, it's a different numbering system over here, right? And imagine this, they all used to be done in fractions, just the market changed at some point, and now there's not very many that use this. So you can see that there are 32. We'll just scroll up a little bit till we get to 1. So we hit the full number, 154, and then we got 154, 1 over 32, 2 over 32, 3 over 32, yada, 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 right? On and on and on. And that keeps going up until we hit 31. Because when we get to 32 over 32, well, that's a whole number, right? And so that it wouldn't show us 32. It just shows us the whole number, 155. But then we move on from that to 155 and 1 over 32, 2 over 32, right? And again and again. So don't let this become something that scares you or intimidates you. Yes, it's a different measurement, but we've all dealt with fractions before. Whether you like using fractions or not, it doesn't matter what you like. The program will do the work for you. You don't have to struggle to try to figure this stuff out. You can recognize that for every fractional move up, the bonds will make or lose the tick value, $31.25. Right? And it really is that simple. We don't have to struggle to do this stuff. I am a big fan of trading the NASDAQ. When I trade futures, this is the product that I trade. But I trade micros right now since I'm working on becoming familiar with a trading strategy that is new to me. And of course, I'm past the paper trading and I'm trading it live, but I don't want to risk a lot of capital. So I've been trading it with micros. The micros have a different tick value than the minis. So you don't make as much money, but you're not risking as much money either. And you can see that no matter how much I zoom in here, there are no penny increments. It doesn't go from 74, 29, 26, 27, 28. It doesn't do that. It goes from 74, 29 and a quarter to 74, 29 and a half, 24, 79, 75, 74, 30, right? Only quarter size increments because those are the tick values. It trades, each tick is 25 cents. Now, if we go look at SPY, each tick is a penny. right? It moves in penny increments. Up a penny, down a penny, up a dollar, up a dollar, up a dollar, down a dollar. But futures products all have different tick values, and in the NASDAQ, it moves 25 cents at a time. Always and always. Now, that doesn't mean that it can't gap, because it absolutely can gap. It can go from 74.29 to 74.30 in a blink of an eye. It doesn't have to stop anywhere along the way. It can just gap up there, and it can gap down there, right? But what it won't do is go to 74.29 and 15 cents, right? And so that is what tick value means. So you can see that there's not some mystical situation here. It's not complicated. It's only the language that gets you misdirected, right? So tick values. Since the NASDAQ moves in 25-cent increments, and there's 4 quarters in a dollar, then there's 4 ticks in a dollar. And those 4 ticks make a point, right? So between 7.429 and 7.430 is $1, 4 ticks. Each tick in the NASDAQ is worth $5. So a 1-point move is 5 times 4, $20. Very simple, very easy. So the trading in the futures, you can see that these candles, they move just like all the other candles, right? The NASDAQ is no different than trading the Qs. We could go to the ETF product, the Qs, and we could go trade options in the Qs, and we can just go up here and buy shares, right? So we can trade the NASDAQ with the ETF, and we can trade it with futures, but the candles, they move the same. You can chart them, you can analyze them, you can project and trade it just like any other product. So there's nothing special or unique about the way that futures move compared to anything else. There's different trading strategies that you might want to employ and different protection strategies that you might want to put in place, but that's just because of the volatility that's in the marketplace, right? So I want to thank you for watching this video. I appreciate it, and I hope you look forward to more of the products that I'll be doing on the futures, because now that we've had this introduction, we really want to start dialing into things that we can do to use this information in actionable material, right? I'm always focused on taking what I learn and applying it to trading. And so we're going to continue to broaden our material here at the Bullish Bears website to incorporate not just an understanding and a background of futures, but how we can use that understanding to trade not only in the futures market, but to trade all the other products out there, shares and options contracts, because of how we can look at the futures market to gauge what's going on in the overall market and then apply that to our trading. So I look forward to seeing you when those other videos come out. I appreciate your time and effort, and I'll see you later.